The role of liquidity in day trading, what you need to know. Day traders need to pay attention to asset price fluctuations, evolving or disappearing trends, overbought and oversold market situations, market sentiment that can be both overly enthusiastic or pessimistic, news feeds, etc. Along the way, it is also important to pay attention to the degree of liquidity of those assets one chooses to day trade. What is liquidity and why it matters in day trading? The kind of liquidity that matters in day trading is market liquidity. Markets for commodity futures, stocks, or currencies are substantially more liquid than markets for fine art or rare books. However, within these markets, there can be substantial differences in the degree of liquidity. For example, stocks like Microsoft, Apple, or Amazon.com all trade with much more liquidity than over-the-counter penny stocks. Crude oil futures are much more liquid than tin or lead futures. How this works for the day trader is that bid and ask prices in a liquid asset are much closer than for one with less liquidity. Being caught in a losing position in an asset with low liquidity can result in substantial losses before a day trader is able to get out of the trade. How to identify liquid assets for day trading. The first place a day trader usually looks to identify liquid assets is trading volume. Consistently high trading volume typically goes with consistently low bid and ask spreads, as well as ease of getting into and out of trades. Order book information and market depth are also useful in identifying liquid assets for day trading. Although some assets may trade with reasonable liquidity, a single large order can have a huge impact if the market for that asset does not have sufficient depth. By choosing assets with routinely high liquidity, the day trader is assured of minimal transaction costs, accurate technical analysis, and reasonably predictable trading. Impact of low liquidity on trading performance. Disciplined day traders make money by analyzing markets and executing trades according to established strategies. This works best when markets are liquid. When they are not, large orders disrupt prices. Panic selling can cause a trader to be caught in a devastating position. Poor market liquidity can cause unwelcome and unpredictable volatility with huge price swings, slippage in positions, and greatly increased costs of trading. Strategies for trading in different liquidity conditions. As a rule, it is a good idea to avoid markets and assets with low liquidity. In liquid markets, a day trader can follow an established strategy and exercise discipline in entering, managing, and exiting trades. They can routinely set stop loss and take profit targets and rationally manage their position sizes. To the extent that a trader chooses to trade an asset with poor liquidity, it is important to limit time spent in any given trade, even to the extent of limiting oneself to scalping. As always, if you do not understand the market and asset which you are currently day trading, there is nothing wrong with trading in simulation until you are able to make sense of it and establish a workable plan going forward. Liquidity traps. How to avoid common pitfalls. Assets that trade with low liquidity can be risky for the day trader, but also may provide trading opportunities. One such situation is a liquidity trap. This is not the liquidity trap in the economy when interest rates fall to nothing and everyone hoards cash. Rather, this is a trading situation in which an asset has been steadily trading downward for a prolonged period of time with very low trading volume. It then spikes up with huge volume and brings in lots of new traders. There is subsequent price consolidation with losses of 30 to 50% and low trading volume, 90% less than when the asset surged. When this happens in an asset with normally low liquidity, there is a risk for those holding large sell positions or shorts in the stock market. When traders see an opportunity to profit from an expected price recovery, those traders caught in large, short, or sell positions become trapped because of the low liquidity of the asset, and the asset experiences a spike or short squeeze. The price spikes upward over a few minutes, providing the alert day trader with a very brief trading opportunity to buy the asset, set stop loss, and take profit targets, and get out in a very short time with substantial profits. This is a trading situation that can be devastating for some and hugely profitable for others. As we commonly note, success goes to those who are prepared. Having spent the time and effort to become a benchmark professional day trader with Day Trade Safe is the first step. Success in such situations comes from recognizing their potential risks and profit potential. Then one follows established day trading strategies in a disciplined manner day in and day out, while paying close attention to the market and asset which they are trading. Thanks for watching. Please subscribe to my channel and be sure to check out the free trading guides in the description below.